If you're 50 or older, this video is going to help you pay the least amount of tax over your lifetime. Most people don't figure this out until it's too late, and then they've missed an opportunity to do this. But you're going to have some options. Now, one of these strategies is best for people if you're between 50 and 72, and then the other strategy is best for people if you're over 70. I was talking to a man recently, and he's in his 60s, and he had over $4 million in his pre-tax 401k. And I was sharing some of these strategies, and he was kind of kicking himself because he didn't think about this stuff sooner. But we don't have to worry about him. He's going to be fine. He knows that too. And I know that's a unique situation. Most people don't have $4 million saved in pre-tax monies or IRAs or 401ks, but it actually doesn't matter because this can work for anyone, no matter how much you have saved. If you have something in an IRA or 401k, this could work for you. So let's get into it. If you're between 50 and 70 and you're getting serious about planning your ideal retirement, and you like the idea of not paying any more tax than you need to, or really not paying any tax on IRAs in the future, there's going to be two routes that you can take. And I'll give you some additional resources as well to help you with this. But first, if you're still working, the first step to take is look at your tax rates now while you're working, and then look at the projection of what they could be in the future. I like using the DIY retirement plan that's below this video, or my favorite retirement calculator that's also down there, to help figure this out. And you might also find that simply upping the contribution to your Roth portion of your 401k or maybe your Roth IRA could make sense for you. You also might be thinking that, well, I'm in a high tax bracket right now as I'm earning an income and I've got a wage, so it's going to be lower in retirement. But remember that time, it's on your side. If you put 10K into a Roth now and your effective tax rate was just say it's 20%, you missed out on 2K of tax deduction this year. But let's say that 10K grows to over 30K over the next 15 years. Well, that 30K is in a traditional IRA, and even though your tax rate might be lower in retirement, say 10%, if you were to take that out in retirement, well, you might be paying 3K in additional tax. So really, this is big picture and just a general example, but I'm just trying to give you some things to think about as you're planning and thinking about Roth and post-tax and pre-tax. I'm going to include another video at the end of this one that walks you through really a step-by-step way to evaluate and figure out what gives you the most benefit when it comes to Roth conversions and tax rates and where you might be. It kind of maps it out for you. Even with all this info and these ideas on what to do, there's still a lot of factors that are unique to you and that you need to evaluate before doing anything like this. So I do recommend meeting with a financial professional. One other question that comes up related to this is the question of mega Roth IRA contributions, if you've heard of that before. That's really a whole nother strategy. I plan to do another video on that, specifically on that topic. So make sure to subscribe so that you don't miss that video that's going to come up in a few weeks or so. Now, the second thing to do, if you're still working, is think about upping or building up your non-retirement accounts. So not adding to your Roth, not adding to pre-tax 401k. Think about the non-retirement accounts, and that has to do with this next strategy. If you can build up a substantial non-retirement account, and if you're not working or you're close to not working, you may be in that Roth conversion sweet spot, meaning that once your wage and your income goes away, once you're done with work, your taxable income may be very close to zero. And if you haven't started Social Security, or if you can hold off taking your IRA distributions, this could be a good time to convert to Roth. So some people are able to convert monies into the Roth and pay 10% or less effective tax when they do it. And these are people that are still, they still have expenses and needs of 100K or 150K per year. That's because they built up this side non-retirement account. And they felt confident about doing this because we did projections and we realized that they would be, if they did nothing and just did the status quo, they'd be in the 30% effective tax rate. That means when they're taking money out of their IRAs in a few years, they would be paying close to 30% on those withdrawals. So doing this other strategy made a lot of sense for them. This next one I'm going to fly through because I want to get to the accompanying videos that can help you even more on this topic. Now, if you're between 50 and 70, this next one is still important because even though you're not 70 now or you're not required minimum distribution age yet, you will be, hopefully, in the future. And by the way, if you're watching this so far and it's been helpful, please click the like button so that maybe it can spread to other people who might find it helpful as well. So now, retirees that are at or above the required minimum distribution age, right now it's at 72, they have to take out mandatory withdrawals from their pre-tax accounts, their IRAs and 401ks and 403bs and those kinds. Even if they don't need the money, they still have to take it out. I kind of look at this as like the government saying, hey, we gave you these years of tax deferral where you didn't have to pay tax on the income and the capital gains and things like that. Now it's time to pay up. So they want you to take money out and then start paying tax on it. So if you're getting close to RMDs, and if you want to not pay tax on mandatory distributions because you don't need them, then you could, and you can see yourself wanting to help out a charity or a cause that you care about, you can actually avoid paying tax on some or all of that RMD if you send it straight to the charity, or it's got to be a 501c. Now, if you don't take your RMD out in the year that you're supposed to, you could get penalized up to 50% of that year's distribution. But if you do this, it's called a qualified charitable deduction, and if you send it straight from your IRA to a charity, that counts towards satisfying your RMD amount. And just make sure that you talk to your tax preparer or CPA just to make sure you're doing it correctly and that it's recorded correctly on your tax return. Now onto the 2 videos that can help you further if you want to explore this topic a little bit more. The first one is finding out when a Roth conversion could make sense for you, and that helps you also with tax rates now and then what they could be in the future. It helps you map it out. And then the other one to think about is if you've got elderly parents or if you've got kids that you're thinking about passing money on to, and how you can save money on taxes related to IRAs and distributions in that scenario. And also be sure to check out the do-it-yourself or DIY retirement plan and my favorite Roth conversion calculator down below this video as well. I hope that was helpful, and then I'll see you in the next video. Take care.